So time is a crucial factor in consistency, longevity, and success, meaning that you need to know what you're looking for. Why do the setups, or why should the setups form? What's the basis or premise behind the setups? Like, what makes your trade idea that you're about to take, or what you're stalking or hunting, what makes it viable? Is it something that's, built on your impulsive tendencies to just look for something? Or is it rooted in something that's sound and logic? What is a time-based need or influence in trading? Well, let's think about it like this. You know what it was like to be in rush hour traffic, right? In the States, in the United States, we have generally two times of the day where it's considered rush hour, and you don't want to be on the busy highways and byways because they'll be congested. They are typically in the morning, 7 o'clock and 9 o'clock in the morning, and in the evening time or afternoon, it's 3 p.m. to 5 p.m. Those 2 hours in both morning and evening session, if you're looking at traffic like trading, that is scheduled congestion. That's scheduled volume. You can set a clock to volume in trading as well, just like traffic. You know when rush hour in the morning is going to occur. You know where rush hour is in the afternoon. Well, the same thing occurs in trading. And I want you to think about the importance of knowing when there is going to be scheduled volume inflows. What does that mean? Certain times of the day, there is a reasonable expectation that there's going to be a lot of interest to be trading. That's at the beginning of the trading sessions, being like London, New York session AM, or for Forex traders, New York open kill zone, and or the London close session for Forex traders, or the lunch hour for index trading. And then you have the PM session, which is 2 o'clock to 4 o'clock. So you can anticipate setups that will form within those little specific time windows. You need to have this same approach or mindset about trading that you do with traffic. Do you want to go in at the very opening of, say, for instance, 9:30 a.m.? If you're brand new to trading, you don't know what you're doing. That's equivalent to you being a new driver. You don't want to schedule your trading, if you're brand new, at the very opening, like the first minute or two of trading, because you know that now everybody's in there dog piling in to take trades. So you think everybody in there is going to be pushing the market up because of their buying pressure, or they're going to be sending the market lower because of their selling pressure. And again, that's all misinformation, that you're all trying to do something at their incorrect time, and that compounds the likelihood of you wrecking. Just like in traffic as a new driver, you don't do all those high speed maneuvers when you're inexperienced. You don't distract yourself with social media during your driving or in your trading. That means keeping up with everybody else. You need to be minding your own business and watching where you're traveling. You have to anticipate the thoughts and expectations of individuals that are going to see price action, and they're going to anticipate nothing in the future. They're going to react. They're going to chase, which is why my Judas swing is so effective at the right time. So when we look at price, or when we're looking for setups, or we're trading a particular model, time is a very important factor. There has to be a reason for that trade to even materialize. And you don't want to go in there in the first few minutes of trading and say, okay, this is it. I'm going in because now the markets have opened. Everybody else is dogpiling in. Everybody else is creating this congestion like rush hour. And I'm afraid I'm going to be left behind. So I have to do what? I have to react to what I see in the price action. So therefore, I have to do whatever else is doing, and that's wrong. That's absolutely wrong. Now, put that to the side for a moment and then think about it like this. Let's talk about each individual session, okay, and some of the characteristics that each one of those trading sessions have, and how you should go into those trading sessions with the proper mindset for anticipation, not reacting. When I talk about things that should happen in the marketplace, the primary function behind the accuracy is I'm only really focusing on specific times. because those times are algorithmic. Specific times of the day. There's very specific times of the day where you as a trader can say, I have to be able to control myself and not allow impulsiveness to come into the marketplace. So let's look at the London session. So London, by characteristic, what I'm referring to is, we always refer to things in New York local time. Okay, so London time, between 2 o'clock in the morning, New York local time, to 5 a.m., New York local time. That's a 3-hour window, and the sweet spot is between 2 o'clock and 4 o'clock. So those 2 hours, but it can extend to 5 a.m. Generally, you're going to get some kind of false breakout. Okay, and that's not earth-shattering. There's always been some idea of expectation of anticipating some false breakout in London. That's just the natural characteristic to it. What you need to be concerned about is where we are coming from on the hard time frame, weekly and daily chart. You have to look at what that weekly, what's the importance of the weekly chart, Michael? Well, I talk about how you can anticipate, not react, anticipate where that weekly chart candle that's forming, or that will form tomorrow when it starts on Sunday at 6 p.m. when all trading begins. Now we're starting a new weekly candle. So you want to anticipate the likelihood of that weekly candle expanding up or expanding down. And you're looking for an inefficiency or stops that's most likely going to be the draw. But you have to factor in what that weekly chart is doing, likely to do. And that starts your bias, bullish or bearish. And on the daily chart, you have to confer with the previous day's range. Now let's assume for a moment that the weekly chart, you think that there's going to be an expansion lower on whatever market you're trading. Now this is both Forex and index futures and commodities. Okay, so it's not, unless I say, here's another general rule of thumb. Unless you hear me say this only works for this, which is very, very, very rare, everything I'm teaching you works on Forex and it works on futures, index futures and commodities. Okay. I don't know about crypto. I don't have any affinity for it. So I'm just going to let you discover it for yourself. If it works, great. If it doesn't, I don't care. I don't care either way because I'm not going to be trading in it. So London, you're going to look at the previous day's range. And let's assume that you're looking for lower prices. You think that that weekly candle is going to expand lower. And you want to look at yesterday's daily range. And it does not matter if yesterday's daily range is up close or down close. There's more advantage if the candlestick from yesterday is up close, because you want to see a move that breaks below that yesterday's low. And once it does that, that lower 0.25% or lower third of that daily range, if you are in fact correct about your analysis and it's going to go lower based on the weekly chart, your sell setup is going to form in the lower quarter or lower third of the previous day's range. Now, by itself, that's not earth-shattering, but I'm going to tell you something right now. If you chase price action and you always get burned, go back and look at your losing trades and you'll see that's exactly what you didn't see. So it has to refer back to a previous portion of the previous day's range. And this is not new. This is all in my core content. I teach this in core content. So in London, you're looking for false breakouts. Okay. And you want to see, now this is where you write stuff down, folks. You want to see some measure of a 15-minute or 5-minute relative equal highs inside of the range that would be in the lower third or 1/4 of the previous day's range when you're bearish. You want to look for a single high or a relatively equal, like equal highs, inside of the previous day's lower 1/3 or 1/4 part of the daily range of yesterday. Whatever the yesterday is. If it's a Monday, it's Friday's daily range. Otherwise, it's whatever the previous trading day is. That's pretty simple rules, right, folks? So in between 2 o'clock and 4 o'clock, we would anticipate a rally above those relative equal highs on a 5 or 15-minute chart, whichever one's easier for you to see. Regardless, you'll see it. If you want to use a 15-minute chart as a bellwether, I use that as mine. But you can look at it on a 5-minute basis. And as it rallies above that, what's going to be resting above those relative equal highs or single high? Buy stops. And the characteristic for the London session is to run up and entice traders to chase it going long. When in fact, it's a function of running into buy-side liquidity for smart money to absorb those buy stops and be counterparty as they flood the market with buy orders. Shorts are entered by smart money there because it's a run on liquidity. It's engineered to provide a entry mechanism for smart money to go short. It takes a lot of confidence to take that type of trade because usually in London, the Judas swings are very violent and they're quick. And it feels like it's going to go up 100 pips. It's going to go up, 80 handles on the S&P. Look at this thing move, man. Wow, it's going up 12 handles. Look how fast it's moved. This thing's going to keep on going. If you feel that way, you're reacting to price. When we're looking for that to be a run real quick to get to those stops so that stops can't be pulled. And once that happens and the orders are not pulled by the traders that have those orders resting there, we anticipate price rejecting there and going lower. Now, if you can't take that type of trade or entry in the beginning, you won't. Let's just be fair. I say this all the time. Buying sell stops and selling short buy stops is one of the hardest things to do as a trader because at the time when it happens, it's fast, it's furious, and it's scary. And you have to know what you're looking for, which is why you have to anticipate and predict the future. Now, I know there's no chart here, but I want you to think about it conceptually. Let's look at it like this. If you have note-taking instruments in front of you, this should be an easy thing for you to do. Let's just say, hypothetically, you draw a rectangle, leaving room for a rectangle to the right of it, okay? So you're going to draw a rectangle, and at the top of that rectangle, you're going to say 100 is the high, and the low is 20. So you have a previous range of 80 units. It could be pips, it could be points, it could be whatever. But we're going to say it's 80 units. Then you're going to see where you open up at 2 o'clock in the morning, New York local time. Wait a minute. What do you mean open up, ICT? Wait. No, look, you just said, and I understand that the market starts trading at 6 o'clock. What are you talking about opening at 2 o'clock? Yeah, now we have a new opening range. 2 o'clock's opening price. What is that? The first opening price on the first 1 minute candlestick at 2 o'clock, New York local time. You want to note that. Now that's an important price point. From that price point, you want to see it be, if you're bearish, you want to see it be below the 20 level of the previous day's range, because that's what that rectangle would represent. And that's, for example, let's just say at 2 o'clock on the trading day that you're in right now, say it's 18 in reference to the previous day's range. So now you're below the low of yesterday's daily range. So from 6 o'clock all the way now to 2 o'clock in the morning, the market has done whatever it's done. If those highs, that relatively equal high or a single high in the previous range between 20 and 80, if there's a single high or relative equal highs in that lower 1/3 or quarter point of that previous rectangle that you're drawing out, that represents the previous day's trading, you're anticipating at 2 o'clock in the morning on the trading day that you're watching price at right now, you want to see a Judas swing shoot up. You're going to anticipate that. You're not going to react to it. You're waiting for it. You want to see that very thing happen. Now, as an ultra short-term scalper, you can buy that, but you have to be very nimble because it can go up there and turn on a dime quickly because London is a false breakout characteristic time period. When it runs up there, Why are we anticipating a run back into the previous day's range, but only the lower quarter or 1/3% of the range? Because we don't think that the previous day's high is going to be taken out. And we don't think that half of the previous day's range is going to be a factor at all. The best shorts are going to occur in the lower half of the previous day's range when bearish. What did you just say? The best shorts will occur in the lower 50% of the previous day's range. Where do they form? Above old highs, inside of that range. Where you look for it, just like the algorithm will look for it, it's going to look into 15-minute high or highs or 5-minute high or highs inside that range. So if you're in a 5 or 15-minute chart, it can't hide from you. It's right there. You're looking for turtle soup scenarios, okay? And continuation on the basis of the higher time frame order flow. High a day, low a day is what's formed in the London session. Most of the time, not all the time, most of the time. In New York session, I'm looking for setups in the New York session. The characteristic for New York is a continuation of what? Whatever London did. When does that not occur? If the range expansion that occurred in London and then continues into New York and it trades to a higher time frame PD array, something that I would have been targeting anyway, which was the basis for the draw on the bias for the weekly chart and or daily chart. So in other words, if it gets in my higher time frame target, then what shifts in my analysis? Market reversal profile. Otherwise, I'm looking for New York session to continue in the direction of whatever that higher time frame draw is on the weekly and or daily chart. And I'm going to submit to that. And I'm going to look for the things that I teach you that the algorithm will show in price delivery, inefficiencies, runs on stops, the whole business. I'm looking for those factors to come in agreement with that. And if it doesn't materialize, or if it's wishy-washy, it could be done and explained both directions. That's low probability. It's not a trading environment I'm going to trade in. But you look at it in the basis of time. And how does that move fit in the grand scheme of the last 3 trading days? Where we are in terms of what the weekly candle was likely to do, expand up, expand down. Where did it occur in the calendar event for that particular trading week? Did it occur on the heels of a medium or high impact news driver? In other words, if you look at the economic calendar, if a medium impact or a high impact news event or report or something like that, was it on the heels? Does it occur after that market report hits the wires and people can see the data? Or was it in between a medium or high impact news day? All those factors mean something. And you have to find your own comfort in how you're going to trade. I don't say traders need to be afraid of medium or high impact news days. We want those days because there's going to be a lot of manipulation. And then if they're going to manipulate the market, that means they're going to punish one side of the marketplace. And we can see clearly what side's going to be punished. It's scheduled volume inflows, that these things occur because this is where all the orders are going to come in, or they're going to run for the pending orders that are existent in price action. So in New York session, whether you're a Forex trader trading between 7 o'clock and 10 o'clock in the morning, New York local time, or if you're an index trader trading anywhere between, as early as 7 o'clock in the morning, all the way up to 11 o'clock, you don't want to take any new setups after 11. Unless, now here's the caveat now, unless your model is to trade in the lunch hour, which takes much more experience. In the beginning, I don't want you to try to do that because you probably don't know very well where liquidity would be resting, how it would work against the range that's already formed for that particular day. You wouldn't know what liquidity pool to aim for, what specific low. And if you think about it, when I do trades, well, look at what happened on Thursday. I did it real time. I said, okay, I'm taking 3 of the remaining 6 contracts off because now we're 50-50. Would you have known enough to do that? Chances are probably not. But I left 3 contracts on in the event that I, as the analyst, I, as the trader listening to the analyst in me, was incorrect. So if it was to go lower, I still had 3 on, but I didn't have the 6 on that I had on. I had 9 contracts short, took partials below an old low on a limit. Then 3 off because it didn't continue and left 3 on with a stop that would, if it got stopped out, it was in the black. It wouldn't be a losing trade. It would be a missed opportunity on the final balance. Lunch trading's like that. It takes experience. And sometimes I'll get that lunch hour wrong, which is why I don't do a lot of it. But when it's really obvious, really obvious, I share it with you. And you see people say, you told us not to teach, you're teaching us not to trade in the lunch hour, and here you're trading the lunch hour. I'm the teacher. I'm teaching you when I can do it, when I'm comfortable doing it. It might be a model for some of you, but the New York session is a continuation of whatever London is. So if London was going down and it has not reached your higher time frame daily or weekly objective, we expect some measure of short-term retracement and then continuation in the New York session until the higher time frame weekly or daily objective that we would be reaching for as a draw on liquidity, the target. When that's hit in the New York session, then you are entering New York reversal profile, where whatever happened in London in the early stages of New York now reverse, and the market goes a different direction. Whether if it's going lower, now it will go higher, or if it's going higher, it will now go lower. If and when it hits the weekly or daily objective that we were aiming for, that framed our bias or premise behind our trading week. Silver bullet inside of the AM session. That time window is very, very specific. It's inside of 60 minutes. Now, that doesn't mean the entire trade is encapsulated inside that 60 minutes, but most of the time you're going to find it is. But you can find the entry in between 10 o'clock and 11, and all you're looking for is a continuation of what London and or New York is outlining. So we have a target. We're looking for a draw on liquidity. It could be a new week opening gap that we're aiming for. It could be a fair value gap above the marketplace that we're aiming for if we're bullish. And that draw on liquidity is what we're looking for, a reach from that fair value gap that forms, whatever the fair value gap, the first one that forms between 10 o'clock and 11, that one, you're going to see that right there, that's going to be a catalyst for a minimum 5-handle run. The lunch hour, the New York lunch hour, is technically 11 o'clock in the morning to 1 o'clock in the afternoon, New York local time. So it's a 2-hour window. And the reason why is back in the days where we had open outcry and electronic trading hadn't really taken off yet, sometimes if the morning session had a really nice move, guys would go grab a bite to eat because they felt like that we would have a very busy afternoon session. So they want to go early, beat the lunch rush to whatever it is, they would go and run and get their lunch. Sometimes they would eat at their desk. And others would be just hopped up on goofballs and simply not leaving the floor and just trade through the lunch hour. But lunch hour trading is a real thing. And the algorithm operates on that mechanism of reversing back to whatever the session in the morning stops, wherever they're at, whether they're bull stops or not bull stops, buy stops or bear stops, sell stops or buy stops rather, buy side or sell side. And as an example, let's assume that we've watched the market go higher in London, and then we had a continuation in New York. And whatever the target is that we had for our weekly chart or our daily chart has yet to be reached. So we're still below it. Your expectation for the lunch hour between 11 o'clock and 1 is you want to go through and look for where a relative equal low or a 15-minute low is, because that's exactly where the algorithm is going to go. What makes it better? If there's a fair value gap or a volume imbalance just underneath that low, that right there is a unicorn. That 15-minute low, when it's been bullish and we haven't hit that weekly or daily objective, it's going to roll down there. It's going to go right below that low. And it's going to engage those sell stops. And the market's going to be flooded with willing sellers at a low price. Why, pray tell, would that be advantageous? Because smart money will be buying those sell stops to reaccumulate new longs, add to or start new positions, and wait for that higher time frame, weekly or daily chart objective to be met. And then you'll watch the PM session roll through and reach higher to that target or get closer to it ever so slightly. That's that liquidity matrix. Understanding where you are in it. You have to know where the market's going to go. So silver bullets, you have a fair value gap set up that's very specific in that 60-minute chart or 60-minute time window. 1 hour. At 10 o'clock to 11 o'clock, you have the lunch hour that runs on stops. Whoever's been making money, that's what it's going to do. It's going to run down there. Even if it reverses in the lunch hour, that's still a trade also. If you can anticipate that drop down, say the market's been going up, London session, New York session. Now you're entering at 11 o'clock to 1 o'clock an hour. You can sell short a 1 minute 2022 model and aim for that 15-minute low. What? Yes. Yes, Virginia. Yes, you can do that. That is a model in and of itself. And then you had the PM session, afternoon, between 2 o'clock and 3 o'clock. The same thing you would expect to happen in 10 o'clock to 11 o'clock AM session, silver bullet. Well, look what we have here. Another 60-minute time window. We have to look for stops or inefficiency. Where's the market going? Where's it reaching for? You know you had that old high that you were aiming for all morning. It didn't get there. We have relative equal highs now across the afternoon. What's it going to reach for? The weekly and daily objective hasn't been met above the marketplace yet. So we're still bullish. Wait for a short-term shift in market structure, 1 minute and 5 minute. Wait for a fair value gap to form between 2 o'clock and 3 o'clock. And then when it drops down into it, when you're bullish, buy it and aim for that intraday high. If it can give you 5 handles, take it there. Leave a runner on and see if you can get to that higher time frame, weekly or daily chart. That's how you trade your afternoon silver bullet. Simple. Real simple. There's a whole lot more things you can add to it to supercharge it, though. But that's the easiest, simplest little approach to that model being there every single day. Even in choppy days, it's there. Oh, it's there. Every day. Then you have the last hour trading, 3 o'clock to 4 o'clock. I've taught you several macros that exist in that hour. And now we're talking about the extreme of the daily range for indices. You're not trying to trade Forex back then at this time. At 1 o'clock in the afternoon, that's it. You're done for Forex. Don't touch it after that. I don't care how much you see it do this and do that. You don't trade it. In London close, between 10 o'clock and 12, I apologize. I skipped over that in all my fever pitch about everything that's really outside the scope of this Twitter space that I had in mind. That 10 o'clock to 2 o'clock is the extreme range end of the daily range for your Forex trading pairs. It can extend to 1 o'clock, but generally between 10 and 12 New York local time. You can finish your whole business there and be done. But as an index trader, you're entering the lunch hour. Now you roll out of, say you're a Forex trader, and you want to trade the London session and New York session for Forex. And now you know that Forex goes a little bit colder the rest of the day in the US hours. Stop trading Forex, roll over into indices. Trade the lunch hour. Where's the 15-minute stop? Where's the stops? Who's made money? Where are they leaving their stop? Because this is resting right in the marketplace, and the algorithm will gladly go down to it or go up to it, and there it is. There's a setup there. Then we get that last hour. That's making the high or low of the day for index futures. Not all the time, most of the time. Unless it reaches the daily or weekly objective intraday, and that will be the high or low of the day. If it has done that, then the afternoon last hour trading has to be traded from a scalper's mindset, looking for a 15-minute high or 15-minute low or 15-minute inefficiency above or below the marketplace. And that's your target, and be content with it. Does it offer you 5 handles? If it does, get it and be done. So I've walked you through a daily range, mentioned the characteristics. They're very generic. Do you think about price like that? If you haven't been thinking about price like that, now you should. Because in my mind, the inner musings of the ICT, when I'm watching the daily range form, I have all these thought processes in my mind, and I'm anticipating certain things based on the logic I've showed you and talked about here. New York session, optimal trade entries. London session, turtle soups that shift into 2022 model or optimal trade entry. Breakers really do well in London. Reversal market profiles in New York session. Once the targets on the weekly and or daily chart is met and reached, chances are we have an intermediate term high or low, and then a breaker can be forming there as well. All of these individual times of the day, the silver bullets are always continuation. They're continuations of whatever is in motion at the time. If you can't determine what is in motion, don't take the silver bullet. How about that? How's the logic for that? It's simple, isn't it? When in doubt, stay out.